everyone. Excited to be back with you today to talk about the OBBB Act, otherwise known as the One Beautiful Bill Act, and go through that with you today. This is some of the biggest tax law changes that we've seen since 2017 when the Tax Cut Jobs Act came out. So a lot to talk about today and get through. So I'm going to dive right into the presentation here in a second. But before I want to clarify, there's a lot of politics involved with this bill and anything regarding taxes. And my goal today is to bring you the information as far as how it's going to be affecting you personally and what are some things you need to think about when your own personal planning. So my goal is really to come at this from an educational standpoint and talk about how it could be affecting you and what are the things that you need to be implementing in your financial plan. So first, to dive right in, just a quick overview of what the OBBBA is. So it's the newest tax bill to replace the Tax Cut Jobs Act, which was put in place in 2017. It lasts for 8 years, and all of the tax laws and adjustments that were made within that Tax Cut and Jobs Act were all temporary. So it was an 8-year change in the tax law, but we knew that in 2026, everything was going to revert back to what taxes were previously before that bill was created. So we knew that this would be a big year for taxes because President Trump would want to be making changes and implement new tax rates before it reverts back to what it was in 2017. And so that was really the main agenda item, was the income tax rates and how those would be affected. But then we had all these other tax perks that were added into the bill as well. And so we'll go through those different tax benefits and the things that you need to be thinking about when it comes to your own planning, especially as a court reporter as well. So the first thing, as I mentioned, is the tax rates, the income tax rates. So from the pre-2018 tax rates that we had, they were much higher than our current income tax rates. I know everybody hates taxes, but these are actually lower tax rates than what we had saw previously, and actually historically low tax rates as well. So with those tax rates essentially going to go back and revert to what they were before, there's no change going to be going forward. So the tax rates are going to stay what they are now. But the main thing that this bill did is it kept the current rates, and it actually made those permanent as well. So as long as Congress doesn't come in and change the rates to something else, we don't have to worry about a certain period of time where it's going to revert back to a previous tax rate. The only way that this changes in the future is if a new bill is passed to change the taxes. So there is no deadline or sunset that we have to worry about with these current tax rates now going forwards. So that is a nice benefit for you. Is a lot of people were worried about having the lower tax rates expiring this year, doing different planning strategies and trying to get it done before taxes go up next year, but that's not something we have to worry about anymore, which is great. Next is going to be talking about the standard deduction. This is a small change, but the standard deduction for 2025 was set to be a nice even $15,000 for single filers and $30,000 for joint filers. And one of the changes made here is that it was just a small bump up. So instead of being $15,000 for 2025, it got bumped up to $15,750. And then you just double that for anyone who's married or filing jointly. So a little bit more of a tax deduction for the standard deduction. But I think for this year, we'll have a lot less people doing the standard deduction because itemizing on your taxes has gotten a lot better. And so we'll talk about that as well. And this is why I don't think that we'll have as many people taking the standard deduction this year. It's because we had a huge increase in the SALT cap, which is the state and local tax deduction you get. When you go to file your taxes, you can either choose to take a standard deduction, which, like I mentioned, is going to be around the $15,000 to $30,000 range, or you can itemize and try and deduct your different line items and see if those line items add up to more than what you could get with the standard deduction. So if you could itemize and get more deductions than the either $15,750 or the $31,500, then you're going to want to itemize and get that bigger tax break. Previously, there was a $10,000 cap on your state and local tax deduction. So this includes property taxes and your state income taxes. So especially where I am here in California, that's pretty easy to hit $10,000. And so if the cap for the SALT deduction is 10,000, that could only leave you $5,000 more just to break even with the standard deduction as a single filer. And your only two major options outside of the state and local tax deduction is you get to write off any charitable contributions and deduct that as well. And then you also get to deduct interest on your mortgage up to a $750,000 mortgage and only for your primary residence. So if you didn't do a lot of charitable contributions or you didn't have a lot of interest on your mortgage, it was really hard to qualify for itemizing and for it to be worth it versus just taking the standard deduction. Now for 2025, it actually bumps all the way up to 40,000. So now instead of 10,000, we have $40,000 for our state and local taxes. So for a lot of people, especially higher income earners in states like California, that's an extra $30,000 that they get to write off on their taxes. So let's say you were a single filer and you were only taking the standard deduction of 15,000 for 2025 is what you're expecting to do. Now you could itemize and you could be doing a $40,000 deduction, or if you have mortgage interest on top of that, you could be looking at a $45,000 deduction, right? So now you could be having an extra, I don't know, $30,000, $40,000 that you get to deduct off of your taxes and lower your income this year than you did previously. So that could equate to anywhere from really $5,000, $10,000, $15,000 less of a tax bill for 2025 than what you paid in 2024. So this is the major change that we saw in this entire bill. I think this is one of the biggest changes and actual benefits that we get to take advantage of. This benefit does increase, not exactly with inflation, but it increases by 1% annually from 2026 to 2029. So it is going to go up a little bit. It's not for everyone. As you'll see, as I go through this today, pretty much everything in this bill and really anything in the tax code has an income threshold and a phase out where you no longer get the benefits. So just remember, everything I'm talking about today, there's probably an income limit where you can no longer qualify. So you got to take everything here with a grain of salt on what actually you are going to implement and how much benefit you're going to get. So for this specifically, the way that the calculation works to see what your maximum state and local tax deduction is going to be is you multiply your adjusted gross income minus 500,000 times 30%. So basically the most you could make in this calculation and get zero benefit would be if you made $600,000 or above. And the way I get that number is if you put in 600,000 here as your adjusted gross income, and then you subtract out 500,000, that means you have 100,000, right, of extra above that 500,000 mark. Multiply that by 30%, that's $30,000. That's how much you have to reduce. That's how much you have to reduce your state and local tax deduction. So you were at 40, you made 600 grand, so you did 100,000 times 30%. You have to subtract your 40,000 number here by, this formula by the 30,000. So now we're back to 10 and you get no extra benefit. So it's really only a benefit for anyone who's making under 600,000. You cannot go below the original $10,000 benefit though. So even if you are making over 600,000, you're still going to get the $10,000 benefit. It's not an unlimited deduction to the point where you're getting nothing. You'll always still get that original $10,000 SALT deduction. This is temporary. So in 2030 and beyond, it will go back to the $10,000 limit. So this one, unlike the tax rates, is something that you just get to take advantage of for the next few years, but it's not a permanent change. The next few years specifically, we could be seeing really low tax rates to take advantage of. So maybe there's some strategies you want to do where you want to pay your taxes on purpose right now because you're going to get this benefit that's not going to last. So that's something to think about. There's also a deduction now for car loan interest. So as you saw on the last slide, and I was talking about itemizing and there being a deduction for your mortgage interest, there's now a deduction for your car loan interest as well. It's up to $10,000 of a deduction that you can get. So it's pretty big to have $10,000 of interest a year on a car loan. You either got a really high interest rate or a really nice car. There's a big amount of wiggle room there to get a benefit. However, at the same time, there is an income phase out again here, and it's not that high. It's 100,000 to 150,000 is your income phase out for this benefit as a single filer, or if you're married filing jointly, then it's going to be 200,000 to 250. So essentially how this works is if you're under 100,000, you get the full benefit. If you're between 100 and 150, you get some benefit, but not all of it. And there's a calculation that you can look up for that one. And then if you make 150 and above, then you get no benefit at all. So that's how that kind of income phase out works. And the way that this bill was structured is that you only get this deduction if you're buying a new vehicle that was assembled in the United States. Trump's mentioned a lot about manufacturing jobs and bringing manufacturing to the US. So this is part of that to help those businesses in the US that are manufacturing their vehicles here. So again, you got to have buying a car, a new car that was made in the US to get this benefit. And last thing too, just to make sure I mention it, it's the same thing. It's a temporary benefit. So this is not permanent. So if you're thinking about getting a new car already in the next few years, definitely in 2028, if you haven't pulled the trigger, it'd be something to think about to get at least 1 year of benefit from this. Next is going to be a new investment account for kids. It's called the Trump account. This one I see is not being talked about as much. And I think the reason being is there's a lot of missing details here or just different pieces that need to be finalized. The way that this program is actually going to be run is that the account is going to be set up through the government. So they need to launch the government program. They need to figure out what investments are going to be available. So the idea and the framework is here, but we really don't know exactly what this is going to look like and how it's fully going to be developed. So there's a lot of details. I could probably do a webinar just on this alone, but to give you a high level overview, first and foremost is if you do have a child born between 2025 and the end of 2028, you're going to get $1,000 to start this account. So you'll just be able to go set up the account on the government website and I think submit like a birth certificate and $1,000 will be added to that account. So a nice start to grow that money. And once you put money into this account, because it's for your child, they don't let you withdraw anything until your child's 18. And then there's some weird rules as far as like how much money you can take out. For example, the year they turn 18, you can only take out half the balance. So there's a lot of intricate rules there, but just know that you're putting money in and it's locked up until age 18. But it can be spent for things like college education as well. So it's not exactly like a 529 plan, but it does have some uses where you can take the money out. As far as contributions, there is a contribution limit of $5,000 per year. I put here post-tax because that means you do not get any tax benefit. So there's no perk to you on your own taxes for adding money to this account. So it's not going to help you at all there. However, for you court reporters, we get a nice little perk here where you guys are business owners and you're employees of your business. So as an employee making a contribution to this account, you get no benefit. But employers are allowed to actually add money to this account as a benefit to their employees, which is you. So you can make a contribution up to $2,500 per year as your business and providing a benefit to your employee. And you do get to write that off and deduct that. So this is something that's not going to be available to most of America. But for you guys specifically, and especially our freelance reporters, but even the officials with transcript income as well, you'll be able to make this contribution and get it as a nice tax deduction. So you get a tax deduction on the money when you add it to the account, and then it gets to grow tax-free until you withdraw it as well. So it's almost like an IRA or a 401k in that sense, where it's pre-tax, grows tax-free, and then you get to take it out and then you pay your taxes as you take the money out to be used for your child's benefit. So that really helps as far as the growth of the account. What I've seen on the taxes for this is that it is going to be ordinary income taxes, though, which is a little bit of a bummer. So instead of getting like short-term or long-term capital gains rates, it's all going to be just ordinary income tax as the money's taken out from this account. Next is going to be overtime tax deduction. This probably isn't going to really affect you as a court reporter, but it might in the courts for any officials. If you are working any overtime, you get a deduction here of $12,500 or $25,000 if you're married filing jointly. This is also a temporary benefit as well, so not a permanent change. And again, there's income phase outs with all of these, and they're all around the same 100 to 150,000-ish is where most of these benefits go away. So for this one, it begins at 150,000 for your adjusted gross income. And then the formula for this one is a little bit weird, but for every $100 or every $1,000 that you go over this income threshold, you get $100 less of a deduction. So if we do the math on that, it takes you until $275,000 of income to receive nothing and get no benefit. So at 150,000 and above, you're not getting full benefit, but you're getting some. And then all the way up until you're making 275,000 and above, then you're getting nothing at all. You get no help from this. There was just an important clarification on this as well. You do still have Social Security and Medicare taxes on your overtime earnings. So you don't have to pay federal income tax, but you still have Social Security and Medicare tax. So it's not completely tax-free. Next is a tips deduction. Again, I don't think it's too relevant for court reporters, but just important to understand what are these major changes that we are experiencing with this bill, so you know what's going on. Another one here is that the tips deduction is a $25,000 deduction off of your income. And again, it's temporary, so 2025 to 2028 only, so not a permanent change. And again, another income phase out here. It begins at 150,000. And then this one is a much shorter phase out. You'll be completely phased out and get no benefit at all if you make 190 and above. So just a $40,000 window where you could get some benefit, but not all, not too much there. Next, one that's definitely relevant to you as a court reporter is the pass-through business deduction, otherwise known as QBI, qualified business income deduction. This is something that you've already been getting right now as part of the Tax Cut Jobs Act. You've been getting this 20% deduction. And it's another one of those things that we were going to lose. It was going to go away next year. And now we're not. You're still going to have that benefit going forward. And this is a permanent change. So we'll always have the QBI deduction going forwards. This one's a little bit unique because the way that the calculation works is the 20% deduction is 20% of your owner distributions if you're an S Corp. If you're a sole proprietor, it's 20% of your total business profit. So this is actually one of the weird deductions where it's better if you're a sole proprietor versus being an LLC or an S Corp. Because if you're a sole proprietor, you get 20% off your entire income as your business, your entire business profit. Whereas if you're an S Corp, you can't get the 20% off of your W-2 wages that you pay yourself. So it's only the owner distributions where you're getting that 20% benefit. However, as an S Corp, as we know from past webinars, you get a huge break when it comes to self-employment taxes. So although you're not getting this deduction as much as those sole proprietors are, you make up for it by getting huge benefits from the self-employment tax benefit. So again, it's like a catch-22 here. If you go a S Corp route, you get self-employment tax savings. If you go sole proprietorship, you get this QBI 20% savings. But comparing the two, the self-employment tax savings is way more. So we'd much rather get that. Again, more deductions here, or sorry, more phase outs that we may or may not qualify for based on your income. So not everybody's going to get to benefit from this. And really, this is one of the bigger ones for court reporters and also something to think about when you're deciding if you want to go LLC route or S Corp route, or if you want to stay as a sole proprietorship. Next is going to be a bonus distribution. And what this is actually when you go to buy like a vehicle you're going to be using for work or major equipment that you're going to be using for your business. Depending on what the equipment is and what it's used for in your business, there's a bunch of different rules that apply here. But for certain items, you could only deduct a certain amount in year one. So, for example, you could spend $20,000 on a new car, and in the first year, you could only take a $10,000 deduction off your car. You can't deduct the entire $20,000 bill at once. That may not be the best example because actually with cars specifically, this is not changing. So it'll stay the same there. But for other major equipment purchases or any machines that you're using, things like that, that you may not have been able to depreciate all at once and get the full deduction, now you can. You spend $5,000 on a new stenograph, you can deduct the entire $5,000, or maybe before you could only deduct 20% of it or 30% of it, right? Again, this is a very intricate rule, and it really depends on the equipment that you're buying, on where it benefits you or what changes and doesn't change. So just know that there may be opportunities to write off more business expenses than you could previously for some of your bigger purchases. But you'd have to do this on a case-by-case scenario to see where this comes up and where this makes a difference for you. Another big one that's being talked about a lot is the senior deduction. So it's a new $6,000 deduction for taxpayers that are 65 and above. For this one, it is only temporary as well. So it's going to be 2025 to 2028 is when you're going to be able to get this benefit. So just again, for the next 1, 2, 3, 4 years that you're going to get this benefit here. There is pretty low income phase outs though for this one as well. These are the lowest income phase outs from everything we've talked about so far. So if you're a single filer starting at 75,000, you won't get the full $6,000 deduction all the way up to 175,000. So at least they do give you a big window where you'll get something, but then at 175,000 and above, you'll get no benefit at all. So there's going to be a formula here that you can look up on how much benefit you lose based on what your income is if you're somewhere between 75 and 175. But best case scenario is that you'd be getting a $6,000 deduction if you're over 65. Another helpful one is the child tax credit change. This isn't too significant. We're going from a $2,000 child tax credit to a $2,200 child tax credit. So it's really just a $200 difference. So not a huge change here. And for those of you who maybe aren't too familiar of what the difference is between a credit and a deduction is, a deduction is subtracting your income to see what hits the tax brackets. So instead of making $100,000 for the year, if you have a $20,000 deduction, then you're only making $80,000. So you have 20 grand less that gets put into the income tax brackets to see what you're going to owe. A credit is actually just a subtraction off of your tax bill. So back to my example, let's say you make $100,000 and you have this $2,200 tax credit. The way that works is you have your $100,000, and let's say that goes through the tax brackets. You end up at a 20% tax rate, and so you're going to owe 20 grand this year for taxes. Because you have this child tax credit of 2,200, you get to subtract that off your $20,000 tax bill that you have. And so now instead of owing the IRS 20 grand, you only owe the IRS 17,800. So typically a credit is significantly better than a deduction because the credit is actually lowering the taxes you pay versus just lowering your income that goes against the grid rates for your income tax bill. So credits are better than deductions. And as we look here, this next piece, this 1,700 is the refundable portion. Probably for you guys, it's not going to be relevant, but if let's say that you got all of your taxes covered from all your deductions and everything you did for the year, so you owe 0 taxes for 2025, and you still have extra child tax credit that you didn't use, let's say when you subtract this, it makes you at a negative tax bill, you could get a refund of up to $1,700 back to you from this child tax credit. So you could have a $0 tax bill, and then the child tax credit puts you at like negative 1,500, and you'll get a check sent to you for $1,500. So that's what the refundable portion means. And then again here, more income thresholds. These ones are a little bit higher, but single filer limit is 200,000, and a joint filer is going to be 400,000 for this one. Another one here is going to be the estate tax exemption. This one probably not relevant to most of you. It's a really high threshold, really for like the ultra wealthy here. What it is that when you pass away, you will have to owe money, estate taxes, if your estate is over this threshold. So if you are worth over 14 million when you pass away as an individual, or you actually get to double it as a married couple. So when the second spouse dies, if the second spouse is worth more than $28 million, anything over that, now they have to pay an estate tax on the value of all their assets, right, before it gets paid out to their beneficiaries. So that changed this year where it bumped up to another million. So it's now 15 million instead of essentially 14. So 15 for single filers and 30 million for any married couples. So that doesn't matter too much. Also, same thing here is the gift tax exclusion. What this is that you can give anyone $19,000 per year before it goes against this 15 million. This 15 million here, that's over your lifetime. So you could actually lose some of this money if you're gifting a lot of money to other people. So let's say, for example, that you decided this year you're going to give someone $100,000. You get 19,000 as your exclusion for this year, but you gave 100,000. So that means there's still 81,000 left. So of your 15 million that you have for your whole life, you would have to subtract 81,000 here. And that's something that you're supposed to keep track of on an ongoing basis of how much you have left of your estate tax exemption. Again, this number is so high for most people, it's not even something that you need to keep track of because you're never going to be anywhere near this $15 million number, especially if you're married and you get to double it up to 30 million. But just something that's good to know. And if you are in that space, then this is definitely important for you. So what's not included in this bill, something that was mentioned and is still being talked about, is the elimination of taxes on Social Security income benefit. That did not change. So your Social Security income is still taxable. What they're hoping is that the $6,000 senior deduction would help offset the taxes that you would have from Social Security. But based on where you're at, if you're still working as a court reporter, which I know a lot of reporters like to keep working kind of later in life and really enjoy the career, then that's going to disqualify you from any deduction. And if you are taking Social Security benefits, then it's going to be fully taxable. So we didn't really get too much help there at all, unless you're fully retired and you're able to keep that income pretty low. Also, no changes to self-employment tax rates. This was something that was up in the air as well, but it ended up staying the same. So you'll still owe self-employment tax rates on your W-2 income that you pay yourself, and that'll be 15.3%. So you're paying the Social Security and the Medicare taxes here. And then lastly, not a big surprise, but no court reporter specific changes in this bill. So some industries receive specific targeted benefits to help that industry, but there was nothing specific for court reporters in there. So would have been pretty awesome if there was, but nothing this time. So we'll have to cross our fingers for next time. Again, there's a lot of changes that I just went through today. And really my goal was just to give you an idea of the high level changes that we saw in the tax code. And then if one of these you feel is relevant to you, then you're going to want to definitely dive deeper and learn more about it specifically. But at least now these are the major changes that happened in this tax bill. And you can see what's relevant to you or what might not be and filter down from there, because there is a lot of stuff in here. There are a lot of tax changes that are temporary as well. And these temporary tax changes are going to cause a lot of new financial planning for our clients and future clients. The reason being is maybe there's different strategies like we want to do now and pay taxes on purpose because you're getting so much more tax deductions for the next 4 years. It could push you in a tax bracket that you're never going to be in again, right? Maybe you're in the 24 or 22% tax bracket. And because of all these deductions, we're able to get your income all the way down to the 12% tax bracket. Now we're going to want to pay taxes while it's only 12% and get them out of the way now to build tax-free dollars later on. So it's definitely something that is going to cause new financial planning ideas and strategies. Also something like the Trump accounts where you could get a tax deduction on your business, right? So there's a lot of moving pieces here to think about. So if you do want to connect and talk about your financial plan, how these changes are going to implement your financial plan, and really how you can maximize this for your benefit, definitely reach out and schedule an introductory consultation. We'll do that complimentary with you just to walk you through, again, any questions that you have and make sure you're comfortable with what's going on in these changes that are being presented here today. If you do want to get this meeting scheduled and you're seeing this on Facebook, feel free to just send me a message and I'll send you a scheduling link to book time on my calendar. If you're on YouTube, I do have the link in the description, so you can go find that there. It was great chatting with you guys today and talking about these major changes, and I'll see you next time.